What's going on, guys? Welcome back. So in this video, I'm going to be going over my top 3 stock picks for the month of September. Now, the reason why I'm picking these individual stocks is because I think that due to all the issues going on in the stock market recently, with the whole China trade war, with the Fed being like sending out very mixed signals depending on if they think the economy is strong or if it's very weak, what are we heading for? And President Trump, tweeting a new, radical statement every other day. The stock market has been extremely volatile, and these 3 companies, I think, have taken a massive dip due to this, and I think that it's a bit overblown. I think that creates a buying opportunity in each one of these companies. So if you guys are interested in that, make sure to hit that like button, hit the subscribe button, and without further ado, let's get in the video. So the first stock on my list is AbbVie. Now AbbVie, ticker symbol ABBV, is one of the world's largest pharmaceutical companies. Most of their pharmaceutical innovation has been focused around immunology and then oncology. So in layman's terms, that means people that have autoimmune diseases or people that are experiencing cancer and going through treatment for it. Now, AbbVie's #1 drug has been the #1 drug in the world over the past few years, and that is Humira. Now, Humira's patent in the United States, where AbbVie gets the majority of its revenue from, is expiring in 2023, and that seems to be the biggest headline for the company. And in most recent times, AbbVie has now brought up that they are thinking about buying Allergan, the company that manufactures Botox and a couple of other specialty drugs, for $62 billion. Now, between those two headwinds, everybody has kind of beaten down AbbVie, and everybody thinks that the company is headed for really hard times, and the company is down almost 50% from its all-time high. So I want to go into the good and the bad of what's going on with AbbVie, and then my overall takeaway of an investment in AbbVie right now. So starting off with the good, AbbVie right now is dirt cheap. Fact of the matter is, AbbVie's forward PE is under 7.5. Their adjusted current PE is also about a 7. Their current dividend yields, due to the fact that their stock price has dropped by roughly 50% in the past 2 years, is now over a 6.5%. Their dividend growth rate on that is also north of 20%. And they also have a payout ratio of only 50%. So anybody who is looking for an investment yield or any type of income from their investments, AbbVie right now is a screaming buy when you look at it at a surface level. However, due to the bad categories such as Humira, their #1 drug, maintaining 60% of their revenue, is going to probably get hit very hard in just a few years here in the United States, and that could bring their overall earnings down substantially. The fact that if they do buy Allergan, they're going to be spending about $62 billion worth of debt and equity, so that means that their debt currently on their balance sheet is going to roughly double, which means that their interest coverage ratio is going to go from about a 5 to about a 2.5. And then if there's any other issues that go on with the company won't be able to service its debt, and it'll have to contract, and that'll only lead to bad news for shareholders. However, AbbVie is also working on multiple other possible wonder drugs focused on these two, let's say life drug categories that are in their pipeline. A couple of them recently have just gotten FDA approval, and so in my opinion, I do not think that AbbVie is going to, lose all of the money that they're going to be losing from the Humira patent going away. Obviously, I do not think that they're going to, say, recoup all of that and grow as they were once Humira, was kind of safeguarded. No one had to worry about the patent going, and, it was the #1 drug, hands down, in the United States and in the world. I definitely don't think that that's going to be happening, but when you look at the type of market that AbbVie focuses on people that have immunology and oncology issues. Once you get started on a drug like that, you generally don't stop for the rest of your life, because those two issues are generally either with immunology, you never stop having it. It's, if you have an autoimmune disease such as myself, once you start taking drugs for it, you're just on it, period. You don't stop taking it. If you do stop taking it, bad things happen. So you're on it, and you go about your life after that, but you essentially are a customer for life, and you're locked in generally. And from personal experience of being a patient of this, generally if you are a patient of one particular drug, even when biosimilars come out, your doctor is still very hesitant to switching you over, because all of these drugs are very hit or miss when you initially take them, if you actually respond to them. So in most cases, doctors at least from my experience, hold back from switching your drug up as long as you, as the patient, aren't hard pressed of switching your drug, because there's an off chance that you get off one drug, you go on another drug, the drug doesn't work as well, and then you can't go back on your other drug because your body built up a resistance to it. So I personally do not think the fears of Humira going away are going to balloon anything more than, say, maybe at most 50% of the total revenue. And if you take out 50% of their total revenue, and you add in the Botox acquisition, and then you add, like, say, a couple of their wonder drugs coming in to recuperate, like, say, maybe 10 to 20% of that lost Humira revenue, I think AbbVie, you know, on an adjusted basis like that, would only be dealing with a PE ratio of between a 10 and a 15. So I still think even, you know, that realistic worst case scenario, in my opinion, AbbVie is still trading at a discount to what it normally does, with offering a massive dividend yield and also a massive growth rate. So that's why I think AbbVie is worth looking into today. All right, so the next company on my list is Monster Beverage Corporation. Now, Monster obviously makes the Monster energy drink, and this whole segment has seen a massive amount of growth over the past 10 years, and Monster is now the #1 energy play in the world. Now, when you look at, you know, say the good things about Monster is that Monster has amazing ROI, ROE, and ROA, all of them over 20%. I'll put the exact numbers here. And, you know, they've been rapidly expanding, utilizing very little to no debt. Their margins are extremely high due to the fact that it's a beverage company, and management seems to, you know, be on their A game in terms of expanding into other regions and also working on a partnership with Coca-Cola. So their current partnership with Coca-Cola is one of the biggest moats that they could possibly have, and also their biggest downfall, because if it goes away, the company could get hit severely. However, as that stands, Monster is able to sell any time that, you know, you can buy a Coke product. So that means that Coca-Cola's distribution chain is Monster's distribution chain, and they just give Coca-Cola a kickback. In that same time, Coca-Cola said that they will not enter the energy drink segment, which means that Monster no longer has one of the biggest possible rivals that they would have. Because obviously, you know, if you're a company the size of Coca-Cola and you decide to really focus on making an energy drink, Red Bull, Monster, Rockstar, all those companies would be shaking in their boots, because Coca-Cola definitely has a lot more money to burn than all of those companies together. So the fact that they're already in a partnership with Coca-Cola and are planning to be so for the foreseeable future is a really big bonus, in my opinion, for the company. Now, issues with the company now, and why you've seen its stock price start to fall, is the fact that a lot of people and a lot of investors are worried about if that growth rate that Monster has been experiencing over the past 10 years is going to continue, especially now that the majority of their growth trend is going to be based off of emerging markets and largely due in Asia. Now, personally, I think that the whole energy drink consumption is a secular trend. I think the more and more energy drinks that are out there, the more and more people are going to be using them, because let's be honest, anybody that's a millennial or anybody that's younger, we like a lot of caffeine and we don't like sleeping. So I personally think that this category is going to continue to explode for the foreseeable future. And the only real competitors in this space as of right now are going to be Red Bull and Rockstar, but neither one of them have been executing that well in most recent years. Now, with Monster trying to focus on, you know, widening its portfolio and then also expanding overseas, it is also acquiring and creating brands that, in my opinion, are hurting their revenue and also hurting shareholder wealth. So such as their Rain brand, buying NOS, buying Full Throttle, buying a lot of different brands that, while on their own they were very profitable, but now that you're kind of basketing them all together, and, you know, for most end consumers, an energy drink is pretty, you know, commoditized. You know, if I want an energy drink, at the end of the day, if I really need my energy, I'm not going to care if I'm getting a Monster or a Red Bull or anything. I'm just going to want to get the cheapest one or one that has a good flavor and, you know, go to the gas station, walk out the door and get it. And the fact that they are buying a bunch of very, very similar products, in my opinion, is going to just kind of cannibalize on their own thing, and that is something that a lot of other investors are worried about. Such as their newest Rain brand, it didn't get that customer, you know, satisfaction and the immediate, like, selling off the shelves that people were anticipating, which I personally thought was very obvious it was going to happen, because most people, if they don't know the energy drink brand really well, they generally cast it aside and do not even touch it, because when this space first started, and I know from a consumer standpoint that this was the way it happened, was that you'd have a lot of really small startups just kind of, you know, like, throw out energy drinks there, and you'd try them and they would be god-awful. So most people are kind of, like, you know, fearful of trying out new energy drinks as opposed to, say, buying a new soda. So I think it would be better for Monster to just kind of consolidate with their portfolio and really make sure that they're strapping the Monster brand on everything that they want to push. So with all that in consideration, I don't think that the issues involving Monster right now are Monster's fault. I think that they are, you know, going about things in a difficult way, but I don't think that the consumer no longer wants Monster products. I think Monster's trying to do too many things. So once push comes to shove, I think that Monster will be able to contract on those segments and, you know, continue to grow as they have been in the past in emerging markets. And they've also been seeing a lot of growth, especially in the Southern Asia market, due to their, their low sugar and their low carb fruity drinks. Those are selling very well, and their CEO is very optimistic on that progression in the future. Now, the last company on my list is Domino's Pizza. Now, Domino's Pizza is a company that, over the past few years has been ballooning in terms of its stock price, and it has finally recently taken a massive pullback. Now, the reason for that pullback and the reason for the prior, performance are kind of go hand in hand. Now, the prior performance, Domino's has been growing its revenue at an extremely fast rate, over 15% per year. They are, expanding their margins, they're expanding their ROE, they're expanding their ROI and their ROA, and, Domino's has just been making money hand over fist and at a very alarming rate. However, one of their key metrics, their same-store sales growth, went from being between a 4 and a 6% every year to recently, over the past quarter, only coming in at about a 2.1%. So a lot of investors were expecting that to only get slowed down to about a 3%. So a lot of people freaked out and pulled out of Domino's. However, due to a lot of issues that are going on in this space right now, their CEO kind of came out and said, hey, we're suffering some weakness due to all of these, DoorDash, Grubhub, and everything pushing out all of these, really premium discounts when you first sign up for their platform. So that's cutting into their overall store growth, because people are like, okay, now I can go buy a Chinese food for delivery and I get a discount on it. Let me go to do that instead of buying pizza for right now. But the CEO is kind of confident that that is just going to be, kind of a, it's going to be a tailwind in the future, and he doesn't think it's going to persist for the future. And I also agree with that, largely due to the fact that, these companies, after you sign up and they give you like a couple of coupons here and there, they don't make a lot of money, so they start increasing their fees, and they start increasing their delivery fees. And, at the end of the day, I don't think many consumers that are ordering takeout are really going to deal with the fact that they have to pay $7 for, the ordering fee, and then also the service fee that they get when they go to buy something, say, through DoorDash. Also, not to mention that these companies are relatively new, and they don't really know what it's like to not get free money from investors. So assuming interest rates start to go in the opposite direction, they start going up, a lot of this competition and a lot of the margins that they're losing due to these delivery servers, I think, will start to go away in the future. So I think Domino's, in the grand scheme of things, if you say have a 5-year plus trajectory in your investment, I definitely think Domino's is going to continue to maintain their grasp on the pizza delivery market, and I think they're going to regain all the traction they're losing in the global delivery market, because I think that, everybody's excited with Uber Eats and everything right now, but I don't see that really sticking long term. And I think that Domino's and their whole app and choosing to not switch to those platforms allows them to control their costs in their delivery platform. And, it's also much more reliable, in my opinion, for customers in the long term. So that's my quick overview on my top 3 stock picks for the month of September. Hopefully you guys got some use out of this. Let me know what you guys are picking up in the month of September, and let me know what you guys thought about my individual stock picks here on the channel. Again, I'm just going to disclose this again. I am not a financial advisor, and nothing that I said in this video should be taken as financial advice. But this is just my opinion that I wanted to share with all you guys, so that way you guys could either give me some tips or you guys could look into something that I found pretty interesting. So that's it for the video, guys. Hope you guys liked it, and I'll catch you guys in the next one. Peace.